Okay, so we'll do Laurel. So on 1st Jan 2006, Laurel acquired 60% of the equity share of Rakewood in a share exchange in which Laurel issued 3 new shares for every 5 shares. Bro, what is this? Okay, 3 new shares for every 5 shares. So usually what I do is I just put working notes, and then I'll do Laurel acquired 60%. If it's a share exchange, I'll put down share exchange, and I'll put number of shares that they're exchanging. So that is a ratio of 3 new shares for every 5. So 3 is to 5, or 3 divided by 5. And it is acquired, the share issue has not yet been recorded by Laurel. Additionally, on 31st December 2006, that is 1 year later, Laurel will pay to the shareholders of Rakewood 1.62 per share acquired. So that's a deferred consideration since it's happening 1 year later. And Laurel's cost of capital is 8% per annum. So you just put down deferred consideration, ignore the shares thing. So I put 8%, which is the cost of capital, and the market value of the share. So whenever you're doing share exchange, you always take the market value of the parent company and you calculate it. So they're saying that for deferred consideration, it's 1.62 per share. So 1.62 per share. Now we have 8%, so we calculate the present value amount. So that's 1 plus 0.08 to the power minus 1, because it's for 1 year from 1st Jan to 31st December. Now to find these values, you need to find the amount of shares. So the total amount of shares in the subsidiary, that is Rakewood, usually they'll give you your equity shares of $1 each, right? So 15,000 divided by $1 each. If it was say equity shares of like 25 cents, then it will be 15,000 divided by 0.25. But since it's $1, you just do that, and you get 15,000, which is your number of shares in R, that is your subsidiary. The number of shares acquired by Laurel, that is the parent account. So we know that So Laurel acquired 60% of those shares. So 60% into 15,000, you get the number of shares acquired by Laurel in the subsidiary. So this is how much we own in the subsidiary. Then we have to find the shares that Laurel issued, the share exchange. So they issued 3 for every 5. So you take this, so 9,000 into 3 divided by 5. And then you take your market value, which is 7. So it says in the question, at the date of acquisition, shares in Laurel and Rakewood had a market value of $7 and $2 each respectively. So usually when they give you this particular statement, when they're giving you the market value, you know that you have to do a share exchange calculation. That's why they've given you the market value of Laurel. And if they've given you the market value of Rakewood, then it means you have to calculate the fair value of the NCI, that is the non-controlling interest, at the acquisition date. So for that, we'll use Rakewood's market value. So anyway, screw that for now. So 5,400, that is the amount of shares issued, into 7. So this is your share exchange value. Then for deferred consideration, you take the number of shares owned by Laurel, and then you multiply that with the market value, that is 1.62, and then you get this amount. So the number of shares, that is 9,000 shares, into 1.62 per share, that is how much you're paying, and then that into the present value factor, which is 1 plus 0.08 to the power minus 1, you get 13,500. So now you've already calculated this. This will be used for your cost of investment to calculate your goodwill. So we got that out of the way. Then these are the market values in the question. This is just for reference to remember that you have to time apportion everything. So we acquired the company on 1st Jan 2006, and the reporting date here, the statement of profit or loss for the year ended, is 30th September. So that's 9 months. So 9 divided by 12 for all your calculations. Now we'll go to adjustments. So At the date of acquisition, Laurel conducted a fair value exercise on Rakewood's net assets, which were equal to their carrying amounts, with the following exceptions. So the first thing is, an item of plant had a fair value of 4 million above its carrying amount. So when it says above its carrying amount, this is the calculation. So fair value plant 4 million, then you get your depreciation, which is it had a remaining life of 2 years. So 4 million divided by 2, that is your depreciation. Now remember that we have to time apportion our depreciation. So that will be 2000 into 9 divided by 2. So this will be your depreciation that you use in your cost of sales calculation. Then inventory of 800,000 had a fair value of 1 million, and all of this inventory had been sold by 30th September. So they're saying that there was inventory that had a value of 800,000, but now it has been increased to 1 million. So 1 million minus 800,000, you get 200,000. So that is your fair value. So this is what you use in your cost of sales calculation. Now second is, Laurel's policy is to value the NCI at fair value at the date of acquisition. For this purpose, Rakewood's share price at 1st Jan 2006 can be deemed to be representative of the fair value of the shares held by the non-controlling interest. So your second adjustment is basically finding the fair value of your NCI at acquisition. So Rakewood's share price, which was given in the question, is $2 each. Then you need to find out how many NCI shares are there in Rakewood. So since Laurel acquired 60%, 40% is the NCI. So you take 40% into the total amount of shares, which is 15,000 shares. So 15,000 shares into 40%, you get 6,000 shares. So now you have your number of shares that the NCI owns, plus you have your subsidiary share price. So you multiply both of that, so 6,000 into 2, and you get your NCI fair value at acquisition. Now the third adjustment. So Laurel had traded with Rakewood for many years before the acquisition. Sales from Rakewood to Laurel throughout the year ended 30th September 2006 were consistently 1.2 million per month. So since they're saying the sales is 1.2 million per month and not per year, we don't have to exactly time apportion it. So as in, like, while time apportioning it, do not use 9 divided by 12, because that shows 9 months out of 12 months. But here they're saying per month, so you can just use 9 months itself instead of 9 divided by 12. So basically 1.2 million per month. So your intergroup purchases is 1.2 million into 9 months. That is your intergroup purchase. That will be deducted from your revenue and deducted from your cost of sales. Then provision for unrealized profit. So Rakewood made a markup on cost of 20% on these sales. Laurel had 1.8 million of these goods in inventory as at 30th September 2006. So they made a markup of 20%, and they had 1.8 million of these goods as at 30th September 2006. So this is very simple. You take the amount of goods left in inventory and you multiply that by 20 divided by 120. So that is, so if they say markup on cost of 20% on the sales, the remaining amount of goods into 20 divided by 120. If it was a markup on cost of 25%, then it would be 25 divided by 120, 125. Oh, sorry. Yeah, correct. So, so that's your unrealized profit that will be added to your cost of sales. Next is Laurel's investment income consists of its share of a dividend of $500,000 paid by Rakewood in August 2006. Now, whenever your subsidiary pays you any dividend, you have to deduct that from your investment income. So first things first, dividend paid by Rakewood is 500,000. You deduct this from your investment income in the profit or loss. statement. Then a dividend of 200,000 received from Arctic, a 25% owned associate, which it has held for several years. Which it has held for several years. The profit after tax of Arctic for the year ended 30th September 2006 was 2.4 million. So this investment income of 200 is already included in the investment income, so you don't have to add that. They're just telling you that investment income has this amount, and then they're just casually telling you that the profit after tax of Arctic for the year ended was 2.4 million. So what you do with that is you have to calculate your investment income from the associate. So since you own 25% of the associate, you take 2.4 million into 25%. That's your investment income from associate. This will be added to your statement of profit or loss, and this dividend paid will be deducted from investment income. Next is assume except where indicated otherwise that all items of income and expense occur evenly throughout the year, and there was no impairment losses within the group during the year ended 30th September 2006. If there was an impairment loss, that would be charged to your administrative expenses, or if they tell you that it is charged to depreciation, you charge it there. But there are no impairment losses, so don't have to worry. Now calculate the consolidated goodwill at the date of acquisition of rate. So when they ask you to calculate consolidated goodwill in a statement of profit or loss question, you just follow the same format. So you need to find your net assets of your subsidiary at acquisition, and using that fair value amount to calculate your goodwill. So first we look at net assets of the subsidiary at acquisition. So we're looking at Rakewood's net assets. So they've given us the share capital. So you take your share capital as usual, and retained earnings. So they might confuse you by saying retained earnings from 1st October 2005. Ignore that, just bring. So your retained earnings is brought forward. So just the whole amount here. And then your earnings from 1st October to acquisition. So 1st October to acquisition, that is 3 months. So October to November, November to December, December to Jan. So 3 months, you take your profit for the year of the subsidiary, that is Rakewood, and then you time apportion it into 3 divided by 12. That is your amount. Then your fair values that you've calculated, so plant and inventory. So plant is 4,000, inventory increased by 200, added here. So then you get your fair value at the date of acquisition. Now you can calculate your goodwill as usual. So your cost of investment includes a share exchange and deferred consideration. These we already calculated here itself. So we take that, add this. Add this. So share exchange and deferred consideration. Then you have your NCI fair value. So your NCI fair value also we calculated, which is 12,000. Then your fair value at acquisition is this. You get your goodwill on acquisition, 7 marks, easily got. Now comes your working for cost of sales. So okay, I'm sorry about that background noise, but yeah. Okay, so now we have to calculate our cost of sales. So for calculating the cost of sales, you go to your statement of profit or loss that's given to you. Cost of sales for Laurel, you put the full amount, you plug in the full amount. Then you have Rakewood. So since it is time apportioned, this 34,000 into 9 divided by 12, and you get this amount. That is Rakewood's cost of sales. Now we've already calculated our profit, unrealized profit, our depreciation, intra-group sales, and our fair value adjustment for inventory. So you plug in all those amounts. So your unrealized profit, depreciation, remember it should be time apportioned. So this amount is already time apportioned. from the working itself, which is 9 divided by 12. And then your fair value inventory adjustment, 200. The sum of all of this, and this is your cost of sales. So this is the amount that will be plugged into your statement of profit or loss. So your revenue, 84,500 plus the time apportioned amount, that is 52,000 into 9 divided by 12. So that plus that, and then you minus your intergroup purchases also from revenue. Then your cost of sales you already calculated, you plug in that amount, you get your gross profit. Then your distribution cost. So everything should be time apportioned. So include all of these amounts at its full value and time apportion these amounts. So distribution cost in the question, 1,600. If you time apportion it, it is 1,200. This is the value. So 2,000 plus your 1,200. This minus 1 I've added just to make the values negative, so I can use the sum function. Administrative expenses, same thing. Then you include your income from associate. So that is your profit for the year into the into 25%. That is how much you own in the associate. Then you have your investment income, which is 500. So investment income, you have 500, you minus the 500 that you received from the subsidiary, and then you add the um, you add 400 in that, right? So deduct any intra-group difference paid by us. Then you have your deferred consideration. So this is where you just increase this by 8% and then you time apportion it. So 13,500 into 8%, you get this amount, and then this into 9 divided by 12. So you time apportion that, add up everything, then you get your profit before tax, and your income tax expense should also be time apportioned. So this is the sum summarized for you.